two retirees earned the exact same 6% average return, but one ended up with $419,000 less after just 10 years. Same average, same portfolio, same withdrawal amount, very different outcome. In this lesson, I'm going to show you why the word average may just be the most dangerous assumption in retirement planning, especially once you start taking withdrawals. Because retirement isn't about the average return, it's about what happens first. And if negative returns show up early while you're withdrawing income, that's when permanent damage can occur. Let me show you exactly how that happens. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education to help you protect your wealth and generate guaranteed lifetime income so you can retire financially relaxed. Let's start with the definition first. The sequence of returns risk is the danger that negative market returns occur early in retirement while you're taking out withdrawals. And this is critical because when losses happen early, four things occur. You withdraw from a declining portfolio, which means you lock in losses and you reduce capital available to recover, and this can permanently change your long-term outcomes. So sequence of returns risk is not about the average return, it's about actualized returns and the order of returns. And this matters a lot in retirement, and here's why. Because if during the accumulation years, market downturns happen, you have time to recover and you're not withdrawing. So time is really on your side. When you're moving into retirement and you're moving into the distribution years, you're withdrawing while the market is fluctuating. This means that losses early on can reduce the capital available to grow back. You don't have as much time to recover. So you really don't want to be taking income from a drawing down portfolio during the distribution years. All right, let's make this simple using an example of a 25% average rate of return and why it's an illusion. Let's say that you start with $100,000 and in year one, you gain 100%. Well, now your money is worth $200,000. But then let's say in year two, you lose 50%. Now you're back to $100,000. Then in year three, let's say that you gain another 100%. Now you're back to $200,000. And in year four, you lose 50% again. You're back to your original 100,000. Okay? But here's where the average comes in. You've got 100 minus 50 plus 100 minus 50 equals 100%. We take 100% divided by the 4 years, and this equals 25%. This is your average return equals 25%. But how is that possible when you have 100,000 left after 4 years? That's exactly what you started with. So when we say we've got an average return of 25%, you can see that you end up the exact same at the end of the 4 years. And this is because averages are compounding. This is why it's an illusion that you got a 25% return when you ended up at the exact same place after 4 years. So sometimes you'll hear from various investments that there was a quote unquote 25% rate of return, but then in 4 years you ended up back at the exact same place that you started. That's how it's an illusion. So that example really shows you why averages can be dangerous. If you think that you've gained 25%, but your actual return is 0, now you're withdrawing from your portfolio and you're thinking, well, I have these gains, so it's okay to withdraw, but you're not drawing from a gaining portfolio. You're actually withdrawing during down years, which has a double negative effect because the portfolio is decreasing and you're withdrawing retirement income. So this is where the sequence of returns risk becomes very important to consider, because you don't want to be in a position that you can never recover and you live longer than the money in your portfolio. Longevity really comes into play here. Now let's apply this to a case study comparing two different retirees, both starting with portfolios of $1 million, and their annual withdrawal is $60,000 over 10 years, and their portfolio is returning an average return of 6%. So two retirees, same average return, different return order. In scenario A, there are positive 12% increases down to zero. The returns are strong initially and then turn negative in later years. So you can see here the value is going up and then going down. The portfolio rises steadily in the first half and then declines, but withdrawals are funded by gains. So the ending value after 10 years of the portfolio with $60,000 per year withdrawals is $1,047,000. Now let's flip the order to show you how sequence of returns risk affects the portfolio. In this case, we've got negative returns early on. So the returns are beginning at a 12% loss and recovering only in later years. So then the market's going up later, but because this person is withdrawing from a downturning portfolio, the early losses are forcing selling at depressed values, permanently shrinking the compounding base. So now this is the exact same average rate of return over a 10-year period, and this person ends with $628,000 versus in scenario A, $1,047,000. So what just happened? These two people had the same average rate of return at 6%, but early losses combined with withdrawals caused permanent damage. So there was forced selling where assets were sold at lower values to fund withdrawals. There's reduced compounding where a smaller base means less recovery potential. And there was permanent erosion where capital lost early could not be recaptured. So the difference after 10 years was $419,000. This is how the sequence of returns risk can impact you very negatively. Now, I like to bring you solutions. You know that I am here to bring you safe money protection, safe money buckets. So let's add some safe money protection to this scenario to see how it would make a difference. Instead of withdrawing $60,000 entirely from the market, you could split the income sources. So let's say that you took $35,000 from a guaranteed income source and then only $25,000 from a portfolio withdrawal. Now the portfolio only needs to absorb part of the withdrawal pressure, and this reduces sequence risk exposure significantly. So in this case, let's say that you have a safe money bucket using a fixed index annuity. So the core features of an FIA are principal protection from market loss, the growth is tied to index performance, and there's no negative returns due to market declines because let's say in a decreasing market, an FIA has a floor of 0%. So you have the opportunity to gain when the market is up based on the cap and par rates of that specific FIA, but you'll never lose because there's a 0% floor. So you're not going to be drawing from a downturning portfolio. So let's think about how an FIA reduces sequence risk. If a downturn happens in year one, your FIA does not lose principal due to market decline. So there's volatility protection using an FIA. You've got this protected bucket, which reduces your total portfolio damage during early downturns. You've got recovery time, which gives market assets space to recover without forced selling. And an important note is that an FIA alone does not automatically guarantee lifetime income. You've got to add an income rider to an FIA annuity. So let's check out what that would look like. What this adds is a contractually defined lifetime income stream, an income base that grows during deferral years. This is going to be based on various contract terms. And you get a payout percent based on the age at the income start. So let's look at this example of a hypothetical 60-year-old who puts in $500,000 of premium. There's a premium bonus of 8%, and the roll-up is 8% compounding over a 10-year deferral. And this is just a current example. This is going to yield $86,854,000 of annual lifetime income at a 7.45% payout rate. And let's look at this in my software. All right, here you can see I just put in a sample case, Colorado, that's my state of residence, but obviously we can change this to where you live. $500,000 of initial premium, like I said. I'm using this to show you an FIA, fixed index annuity with an income rider. This is for a female. Let's start with a single lifetime income. So remember we said that they are 60, they deferred until 70. Now the income base has grown and there is $86,854 of income per year. That's a monthly rate of $7,238 per month. If we switch that to joint income, in this case, both of the individuals are 60 years old. They defer for 10 years. Now they've got $6,752 per month, or an annual income of $81,024. And you can see when you run down this list, there are several options of different carriers, and different terms are going to apply for each of these guaranteed lifetime income. But I just wanted to show you an example of how this can play out when you have protected streams of income from an income annuity, so that you don't need to be drawing down from your portfolio. You've got this guaranteed lifetime income that's going to protect you and give you a hedge and a buffer of safe money in your portfolio, so that you can let your other money grow and you don't need to be withdrawing from it during those years of volatility. So this is really the power of why income riders matter for sequence risk. When essential expenses are covered by guaranteed lifetime income, you have no forced liquidation, you don't sell equities during downturns, you can reduce your panic and have fewer emotional decisions in volatile markets. And you've got stable cash flow when retirement income remains predictable. What this offers you is your income floor is met first, and then you've got growth second. This really gives you peace of mind so you can sleep soundly. You hear me say it every time here at the Retirement Income School that my goal is to help you retire financially relaxed. This is what this Safe Money bucket gives you. And it's also important to think about how dividend-paying whole life insurance can act as a volatility buffer. So with dividend-paying whole life insurance, you've got accessible cash value, which gives you liquidity. You can have policy loans accessible. Of course, this is going to depend on the way that your policy is built, but you have that liquid reserve that you can pull money from. Let's say that there's a market downturn and you've got this cash value sitting in your whole life policy. You can withdraw that for a downturn year so that you don't need to draw from your portfolio in that downturn year. And that way you've got this safe money hedge in your whole life policy. And when you pull money from your whole life policy, it's tax advantaged supplemental income. What this does for you is that during market declines, instead of withdrawing from a depressed portfolio, you may use this alternative liquidity source, protecting your long-term compounding assets. So annuities give you a safe money bucket, whole life gives you a safe money bucket. These are both going to protect you from the sequence of returns risk. So here's how this all comes together in a 4-layer protection model. At the base layer, you've got your income floor, which is met with an FIA, a fixed index annuity with an income rider. That's going to give you guaranteed lifetime income, meeting your income floor. Layer 2, you could have a bucket of principal protected growth. So there are FIAs without riders. These are built for accumulation, growth, and protection. Layer 3, you could have that whole life liquidity reserve. This gives you the ability to pull from the whole life policy in times where the market is down. Of course, whole life gives you many other benefits, but we're focusing on sequence of returns risk in this lesson. And then in the last layer, you could have your market assets for long-term growth. Now, this is going to be specific to a retirement portfolio because you've got different stressors on you in the decumulation phase than in the accumulation phase. This is where safe money buckets become even more important, especially if you have longevity on your side. If you think that you're going to live 30 years in retirement, you retire at 65 and you have the potential to live to 95 or 100, you want to make sure that you have some protection in your portfolio using these safe money buckets of annuities and whole life insurance. So this 4-layer model reduces sequence risk exposure, and each layer serves a distinct role in protecting retirement income. If you want to chat with me about how to protect yourself from sequence of returns risk using annuities and whole life, go to retirementincome.school. You'll see a button at the top of the page that says book a Q&A call. We'll have a chat, and if we move forward, we will create a personalized solution for you and monitor it over time. Again, that's retirementincome.school. Book a Q&A call at the top of the page. That's a wrap on this lesson. If you have not yet subscribed to the Retirement Income School podcast or YouTube channel, do so now. Be sure to turn on the notification bell so you never miss out. Leave me some comments, give me some thumbs up, and continue to stick with me here at the Retirement Income School, where you'll learn how to keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.